This is Create the Next from ProCFO Partners, where every week we explore strategies and ideas for financial management and growth to help today's businesses put their financial picture in context.
I'm Chris Mitliff. I'm here with Tony Spina from ProCFO Partners. And today, Tony, I want to talk about cash flow a little bit and cash management. In a lot of organizations, I think that we've got a real sort of binary sense of what's happening with the cash. Either we've got some enough coming in or we've got enough going out. But I'm wondering what you think about the idea that really if we look at our cash situation, we can read between the lines. We can see some of what's affecting the company. We can see some of maybe the dysfunctions that are happening inside of an organization by looking a little bit more acutely at what's going on inside of cash flow. Do you have some ideas about that?
Well, yeah, let me just start by saying, dysfunctions, if you will, to use that term that you used, as they relate to cash, usually show up in working capital, Chris, specifically in receivables, inventory, and payables. You may have strong revenue numbers and, things are good that way, but your receivable balances are growing. And, the average time it's taking you to collect from your customers is being extended. That in and of itself will put a little stress on cash. Similarly, with inventory, your inventory balances may be going up. Your inventory is not turning quickly. There could be a lot of reasons for that on the product side or from the operations side. And on the liability side, payables, that's what you owe people for your inventory and other things, right? And expenses to run the business. That at the same time could be going down, meaning that perhaps you're not taking advantage of your vendor's credit terms and you're paying things a little bit too quickly. All of these things affect cash. And the idea is to turn your assets to cash quicker. And some of these things, if they get extended, the average time it takes you to turn your profits to cash is taking too long.
Wow. So what's the relationship between I don't have the right reports in front of me that are giving me all of that insight so that I can make smarter decisions, and I'm not measuring enough of that in real time? Are most organizations doing one better than another, or do you find that a lot of times when you're working with somebody, they weren't even thinking about some of these big things?
Well, let's address your first point with regard to what should I be looking at. I've often get the for lack of a better word, the lament of the business owner or the CEO that, gee, I'm looking at my profit and loss statement and I've got a profit. My profits are relatively good, but my cash balance is going down. Why is that? Like I said, it's important to remember that a profit and loss statement is just looking at revenues incurred, revenues earned, and expenses incurred over a defined period. It's not looking at things, the effects of balance sheet activity, if you will, on cash, the amount of money it takes to fund receivables, the amount of money being spent on inventory. It doesn't take into account any payments you have on loans or purchases of equipment or distributions made to partners or shareholders to pay taxes. None of these things flow through a profit and loss statement. So even though you may have revenue and profits, the profits that you're yielding may not be enough to cover things like that, causing a decline in your cash balance. A balance sheet, on the other hand, just looks at a cash position as of a point in time. And we know how valuable that is, right? It changes tomorrow, the next day, the day after that, et cetera, et cetera. The third financial statement is a cash flow statement. And you'd be surprised at how many businesses do not generate a cash flow statement as part of their monthly package. And a cash flow statement is where you're going to see exactly how your cash changed over a given period, how it moved. It's going to show you if your receivables went up, your inventory went down, or your inventory went up or down, the payments you've made, on loans or credit cards or other liabilities, and also distributions and any investments made in capital expenditures. It's important to remember when you look at an income statement, profit does not equal cash. And that's the purpose of a cash flow statement. Businesses run on cash, not on profits.
That's a really powerful statement, and in my experience is sometimes not taken to heart. So this cash statement, this cash flow statement is one of the key reports that a lot of companies are missing. Is that?
Yes, that's a fair statement.
Isn't that interesting? So this report that could really help pave the way for a strategic perspective for the next several quarters or whatever is often not even in the mix. So what's your guidance for a business leader or for an executive to start putting together the right package without being too much, but the right insight, the right level of information so that I'm making smart decisions with sound knowledge about what my cash position really is?
What you really want to look at is your cash conversion cycle. How many days is taking you to collect from your customers? How many days is your inventory outstanding? How many days is it taking for you to pay your bills? The net of those three, if you will, is what is your cash conversion cycle. How long it's taking you to convert your working capital to cash. So that's one thing you want to look at, because any improvements there, Chris, are going to have an immediate and drastic impact on your cash position. For instance, with regard to accounts receivable, which is a good example. If a $10 million business were to reduce their average days outstanding by even 6 days, do you know how much that would yield in improved cash flow? Approximately?
No. How much?
About $160,000.
$100,000?
$160,000.
$60,000 by 6 days.
6 days, that's all. Some of the other things are a little harder to calculate, like the effect of inventory, but they have similar effects on cash flow. And, timing is everything, especially with, for a small to mid-sized business, or maybe an S Corp, for instance. The cash is in the business and the cash is earning profits. But at the end of the year or, soon thereafter, when it comes to pay the tax man, they need to take the money out of the business to pay the taxes. So it's critical that the business has enough cash in order for them to take and, pay their personal liabilities there. So that's often overlooked. But one other thing that I like to promote in any business, whether obviously it becomes a little more important if your cash is stretched, if things are tight, is the value of a cash flow forecast. Okay, it's like driving a car. If you're going on a car ride, you get in the car, you know where you've been, right? You get in the car, you're driving along, you know where you are, and ultimately you reach your destination, and you know where you're going. It's kind of similar with cash. Maybe how you started out and where you're at now, but it's vitally important for even a healthy business to know what their cash position or cash needs looks like, on a go-forward basis, looking out into the future. There's a lot that goes into a cash, to a projection, but they're invaluable. They can identify cash flow projection, can identify stress points. Do I have enough cash to sustain my business? Or even do I have enough, will I have enough cash to fund any growth initiatives?
It really speaks to the huge impact that seemingly small levers can have. And I imagine, renegotiating vendor relationships or renegotiating or restructuring some debt relationships, or even how you're using revolving credit can have a huge impact. Small things that you might, may not be the first thing that jumps to mind can have a huge impact on what that cash projection can look like and on your ability to overcome maybe some of those, the peaks and valleys that we all experience in business to have a stronger cash position going forward.
Right. And the value in a cash flow projection, it's not about being right. It's not a budget. Budgets are static. Budgets are something you produce perhaps once a year, and you measure your results against where you expected or hope to go, however you want to look at it. Okay. With the value in a projection is how can I put this? The value in a projection is it gives you the ability, to look ahead and paint a reasonable picture of what things are going to look like in the future, and take action, if you will, to improve on it. If you see that in 4 months, I'm not going to not have enough cash to pay my vendors, what can I do about it? How do I get more cash in here quickly? Is it simply a matter of improving my collection days with customers, getting them to pay quicker? Is it restructuring some of my payables? Is it buying less inventory, managing inventory a little better, which is a whole nother, wide topic. People in manufacturing or people, even a distributor knows inventory is always an area where there's a lot of opportunity.
And back to your analogy, if I'm in my car and I've had flat road with the wind behind me, my ability though to look ahead and say, we've got some mountains coming up, our gas mileage is going to go down, and it looks like there's stormy weather for the next 3 days. We should plan accordingly. Those are the things that we naturally do when we're trying to get from point A to point B. But often in business, we're only looking at what the past is telling us about where we are. We're not doing enough to look, as you say, the projections that are so essential to our growth.
Right. And with regard to cash flow projections, I mean, every business is different and dependent on, what their health is. The frequency or, how long you want to, project out may change. If things are very tight, I often recommend the short-term cash flow forecast, if you will, which would, typically be a quarter or 13 weeks. And, once you put that together, it doesn't just, like I said, it's not static. It doesn't sit there. It's something that has to be updated, regularly, daily, usually weekly, but daily if necessary, because things change, right? A customer that was paying you, within, say, 30 days, for the last 5 years, you don't know you might not know what's going on in his business, especially these days, right? With the pandemic, and, that may change. If you're relying on one big customer to pay you quickly and something changes in his business, that affects you. And now all of a sudden, I'm not 30 days out on my largest customer. I'm 45 or even 60. I don't have the cash reserves necessary, to fund my operating activities, on a standalone basis. Then, I have to make some adjustments.
This really speaks, Tony, to the value of the expert CFO who sees this stuff, who understands it, who's seen it all before. This isn't new. This is familiar and practiced. And I think for a lot of executives who are hearing this and thinking, whoa, we're not doing this or this or this, it really grounds us in good guidance and advice that the right expert partner can just take some of that load off and help us have a more solid ground on where we need to be with our own vision, without being distracted by details that we don't understand. I think that's really powerful stuff. Tony Spina from ProCFO Partners, thanks so much for spending some time with us today talking about cash projections and cash flow management and cash flow. Fascinating stuff, really valuable stuff. And I think our audience took away a lot of practical, tactical, how-to, actionable stuff in this one. I really enjoyed it.
Well, thank you, Chris. And I'll just add, I think cash is everybody's favorite topic, is it not?
Absolutely true. Everybody's favorite or least favorite. It's true.
All right. Thank you, Chris. Have a good day.
Thanks for watching. And a special thanks to our subscribers. Consider becoming one today. Visit ProCFOPartners.com for more strategies and ideas for financial management and growth to help you put your business's financial picture in context.